In the vast, interconnected world of global finance, there are markets that operate in the full glare of public scrutiny: the stock exchanges, the bond markets, the daily tides of currencies. But beyond the light, there exists another world, a shadow economy that has quietly grown into a behemoth. Imagine a corner of the financial universe that, in just over a decade, has swelled from a niche curiosity into a nearly $2 trillion titan. That's more than the entire economic output of Canada, or Brazil, or Russia. It's enough capital to buy Apple Inc., the world's most valuable company, outright. This is the world of private credit, and for the most part, it has operated silently, efficiently, and very, very profitably. But now, a voice from the past is sounding a loud, clear alarm, warning that this shadow market may not be the safe haven it appears to be. He's warning that it might just be the breeding ground for the next global financial crisis. That voice belongs to Jim Chanos. For those who follow the markets, the name is legendary. Chanos is a financial detective, a corporate Cassandra who has built a career on finding the rot in a company's foundations before the walls come crashing down. He is, most famously, the man who called the collapse of Enron, exposing one of the most audacious corporate frauds in modern history, while others were still cheering its success. His track record gives his words a unique weight. When Jim Chanos speaks, Wall Street is forced to listen. And right now, he's pointing directly at the booming, secretive, and largely unregulated world of private credit. So, the question is not just what is he seeing, but why is he seeing it now? What are the hidden fractures in this $2 trillion machine that have captured the attention of the world's most famous short seller? To understand the warning, we first need to understand the beast. What is this market that Chanos is so concerned about? The story of private credit begins, as so many modern financial tales do, in the ashes of the 2008 financial crisis. In the wake of that meltdown, regulators around the world enacted a wave of new rules, like the Dodd-Frank Act in the US, designed to prevent a repeat performance. In simple terms, these new rules forced traditional banks to become far more cautious. They had to hold more capital, take fewer risks, and step back from the lucrative but dangerous world of complex corporate lending. But the world of business never stops needing money. As the banks retreated, a new kind of lender surged forward to fill the void. This was the dawn of the private credit era. An entire ecosystem of non-bank lenders, giant asset managers like Blackstone and Apollo, specialized private equity firms, and dedicated credit funds began lending directly to corporations. For companies, especially those in the mid-market, this was a godsend. They could get loans faster, with more flexible and customized terms, and with far fewer headaches than dealing with a highly regulated bank. But the real magic, the fuel for its explosive growth, was on the investor side. These private credit funds offered a tantalizing promise to their clients: pension funds, insurance companies, university endowments, and sovereign wealth funds. It was a promise of high, steady returns, often in the high single or even double digits. Chanos himself perfectly captured the allure, describing it as the promise of equity rates of return for senior debt exposure. Let's translate that. Senior debt means you're first in line to get paid back if a company goes bust, which is supposed to make it very safe. Equity rates of return means you're getting the kind of profits you'd normally only expect from a much riskier investment, like buying stock in a company. So, you're being offered the best of both worlds: high rewards with low risk. It sounded like the perfect bulletproof investment. And as trillions of dollars poured in, the private credit market became one of the most powerful forces in modern finance. But as the old saying goes, there's no such thing as a free lunch. And in finance, when something looks too good to be true, it often is. For Jim Chanos, the first public sign that something was deeply wrong in this supposedly safe market came from a place you'd least expect it: an ordinary auto parts manufacturer from Ohio. The company was called First Brands Group. On the surface, First Brands was the backbone of American industry. It made essential, unglamorous products: spark plugs, oil filters, windshield wipers. It was a tangible business with factories and workers, a world away from the abstract complexities of Wall Street. But in the fall of 2024, the company imploded. It filed for a sudden, chaotic bankruptcy that sent shockwaves through its network of lenders. And as the lawyers and accountants began digging through the wreckage, a truly staggering figure was unearthed: almost $12 billion in debt. The shock wasn't just the sheer size of the debt for an auto parts company. The truly terrifying part was how much of it had been skillfully hidden from view, tucked away in a complex web of what's known as off-balance sheet financing. This is the moment the story transforms. It's no longer about a simple business failure. It becomes a chilling echo of a financial nightmare from 20 years ago. First Brands, it turned out, wasn't just borrowing money from the booming private credit market. It was using the market's opacity and complexity to construct a dangerously misleading picture of its own financial health. And for Jim Chanos, this case was more than just a one-off disaster. It was the canary in the coal mine, a living, breathing example of the systemic dangers he had been warning about. So let's use the First Brands collapse as our roadmap to deconstruct the three huge red flags that Jim Chanos has identified in the private credit market. Red flag number 1, the ghost of Enron, off-balance sheet financing. This is an accounting trick as old as the hills, but it's been given a new, supercharged life by the private credit boom. Here's how it works in the simplest terms. A parent company, like First Brands, creates a series of separate, legally distinct entities. These are often called special purpose entities, or SPEs. Then, the parent company shifts its debt and its riskiest assets onto the books of these SPEs. To the outside world, looking only at the main company's official financial statements, its balance sheet, everything looks great. Debt appears low and assets look clean. It's like having a secret credit card with a massive, maxed-out balance that doesn't show up on your official credit report. You still owe the money, but you've hidden the evidence. This was the exact mechanism that powered the Enron fraud. Enron used a labyrinth of thousands of SPEs, with fantastical names like Raptor and Chuco, to hide billions in debt and inflate its profits. It created a complete fantasy of financial success. Chanos saw through it then, and he is warning that the same playbook is being run again today. Private credit funds, with their desire for complex, high-yield deals and a lack of public disclosure requirements, create the perfect environment for these off-balance sheet games to thrive. Red flag number 2, the 2008 echo, layers of obscurity. Chanos draws his second parallel to a more recent catastrophe, the 2008 global financial crisis. The core of that crisis was the market for subprime mortgages. The danger wasn't just that the mortgages themselves were risky. It was that they were packaged into products of bewildering complexity, called collateralized debt obligations, or CDOs. Think of a CDO as a financial fruitcake. It was a bundle of thousands of different mortgages, some good, some okay, some utterly rotten. This fruitcake was then sliced up and sold to investors all over the world. The problem was the complexity. There were, as Chanos puts it, too many layers of people in between the source of the money and the use of the money. By the time a pension fund in Norway bought a slice of a CDO, it had been passed through so many hands, originators, bankers, ratings agencies, insurers, that it was impossible to know what was actually inside. No one knew how much risk they truly owned. Chanos warns that private credit, in its own way, is creating a similar fog of uncertainty. While the products are different, the principle is the same. Money flows from a pension fund to a giant asset manager, which invests it in a specialized private credit fund, which then makes a highly customized, non-public loan to a company like First Brands. These loans aren't traded on an open market, so their true value is hard to determine. How are they being audited? Who is marking their value to market? With each layer, transparency is lost and accountability evaporates. In the First Brands bankruptcy, this became brutally clear. Lenders are now locked in a chaotic legal battle, trying to untangle who was promised what. Court filings are even examining allegations that the company may have committed a cardinal sin of lending, pledging the very same assets as collateral to multiple different lenders. When the layers get that thick, the potential for fraud and confusion becomes enormous. Red flag number 3, the ultimate danger, common ownership. This brings us to what Chanos describes as the most damning red flag of all, and the one that connects First Brands most directly to the anatomy of the Enron fraud. The investigation into the company's collapse revealed that its owner, Patrick James, didn't just control First Brands. He also personally controlled the very same off-balance sheet entities that the company was using to hide its debt. This is a catastrophic conflict of interest. Imagine the CEO of a company is also the secret owner of the main supplier that sells the company its most expensive materials. That CEO could force the company to buy supplies at an inflated price, effectively siphoning money out of the company and into their own pocket, all at the expense of the company's shareholders and lenders. That's the danger here. When the person in charge of managing the company's risk is also in charge of the secretive entities designed to conceal that risk, the potential for abuse is almost limitless. It creates a closed loop where value can be extracted and moved around in the shadows, leaving lenders holding an empty bag when the music stops. For Chanos, this structure was the key insight that unlocked the Enron case. Seeing it reappear in the private credit world isn't just a red flag, it's a blaring siren. So, what does this all mean for the global economy and for you? Jim Chanos' warning is not about a single company's bad decisions. It is a systemic critique. He is suggesting that the entire $2 trillion private credit industry, an industry that now fuels a significant portion of the corporate world, may be built on a dangerously unstable foundation of hidden risks, lax oversight, and deliberate opacity. He fears that the very features that made this market so wildly popular, its speed, its flexibility, its secrecy, and its promise of high returns, are the very same features that make it so dangerous. The bankruptcy of First Brands, in his view, is not an anomaly. It is a symptom. It is a preview of a coming attraction. He predicts that when the economic cycle inevitably turns, when interest rates rise and easy money is no longer easy to find, we will see a wave of similar corporate collapses. And only then will we discover that the safe, senior-ranking loans held by these massive funds were, in fact, far riskier than anyone was willing to admit. The great financial crisis of 2008 was caused by risks that were hidden in plain sight, packaged in complex products that few people understood until they brought the global economy to its knees. The Enron scandal was born from a culture of deception that was praised as innovation until it was exposed as fraud. Today, from his vantage point, Jim Chanos is telling us to look again. He's urging us to peer into the $2 trillion shadow of the private credit market and to recognize the familiar patterns taking shape within. He is warning us before history has a chance to tragically and expensively repeat itself. The only question that remains is, are we prepared to listen this time?